Warren Buffett made his billions buying value stocks. Cathie Wood became famous betting on growth stocks. But which strategy actually puts more money in your pocket over time? The answer might surprise you. Welcome to AutoTube Finance. Today we're diving deep into growth versus value stocks. Growth stocks are shares of companies expected to grow their revenue and earnings faster than the overall market. Think tech companies, biotech firms, and innovative disruptors. They typically trade at higher price-to-earnings ratios because investors are paying a premium for future growth potential. These companies rarely pay dividends, instead reinvesting profits to fuel expansion. Value stocks, on the other hand, are shares of established companies that appear underpriced relative to their fundamentals. They often have lower price-to-earnings ratios, pay regular dividends, and operate in mature industries. Banks, utilities, and consumer staples are classic value sectors. Over the past century, value stocks have actually outperformed growth stocks by a significant margin on a risk-adjusted basis. This is known as the value premium, and it's been observed across markets worldwide. However, the last decade told a different story. Growth stocks, fueled by the technology revolution, absolutely dominated from 2010 to 2021. The key insight is that growth and value tend to take turns leading the market. Growth stocks shine during economic expansions and low interest rate environments. Value stocks tend to outperform during economic recoveries and periods of rising interest rates. This cyclical nature means both styles have their time in the spotlight. The best strategy for most investors is not to choose one over the other, but to own both. A total stock market index fund automatically gives you exposure to both growth and value stocks in market weight proportions. If you want to tilt your portfolio, consider your time horizon. Younger investors with decades ahead might lean slightly toward growth for its higher long-term potential. Those closer to retirement might favor value for its stability and dividend income. You could also use a barbell approach, holding core value positions for steady income while allocating a smaller portion to growth stocks for capital appreciation. The worst approach is to chase whichever style happened to perform best last year. Growth or value? Why not both? Subscribe for more investment education and drop a comment telling us which style you prefer.